Hey there, welcome back to Accounting Stuff. I'm James, and today I'll teach you almost everything that you need to know about depreciation. I've split this compilation video down into 5 sections. First, I'll give you an introduction to depreciation and show you how it works with journal entries. Then we'll cover 4 different depreciation methods: the straight line method, the double declining balance method, some of the year's digits, and units of production. Be sure to watch this one all the way through to the end to give yourself a complete lowdown on depreciation. Let's begin. Imagine that you own a bakery. One day your oven breaks, so you rush out to buy a new one. You plug it in or hook it up, whatever you do with ovens, and then you're back at it. Mixing, kneading, folding, proofing. Anyway, as time passes, your new oven slowly wears down, just like your old one, and eventually it'll break too. This is where depreciation comes in. What is depreciation? It's the process of reducing the book value of a tangible fixed asset due to use, wear and tear, the passing of time, or obsolescence. An asset is something that you own that's valuable and which will bring you economic benefit in the future. Something like your oven, which you'll use to make money. Your oven is a fixed asset because you'll use it for a long time, and it's a tangible asset because it physically exists. You can touch it. You can't touch intangible assets, and they don't appreciate, they amortize instead, but that's for another day. The book value of your oven is its carrying amount in your business's accounts. We'll get into this soon, but first, why do we depreciate? In accrual accounting, revenue is recognized as it's earned, and expenses are recorded as they are incurred. With depreciation, we're particularly interested in this second line. Expenses are recorded as they are incurred. What does this mean for fixed assets like your oven? Let's say that your oven has a useful life of 10 years. You buy it at the beginning of year 1 and it costs you $8,000. So you physically hand over the cash then, but when do you actually use your oven? Bit by bit over the next 10 years. Depreciation journals are adjusting entries that we post at the end of each accounting period to bring your books into alignment with the accrual basis of accounting. We do this to make sure that all of your oven's use and wear and tear is properly recorded as it's incurred. Not here when you paid for it, but spread out over the next 10 years. How does depreciation work? It begins with buying your oven. If you were using the cash method of accounting, you would expense the entire cost of your oven straight to your income statement as soon as you hand over the cash. But when you're using the accrual method of accounting, you'd capitalize it instead. Capitalization is the process of recording a cost as a fixed asset in the balance sheet as opposed to an expense in the income statement. So you take up your asset cost of $8,000 and hold it in your balance sheet. Then over the next 10 years, you gradually write it off, releasing it as an expense to your income statement. Now, there are a few ways to do this. This graph shows the book value of your oven over time. The simplest depreciation method of all is called straight line depreciation. This is a fixed cost method where the depreciation expense is spread out evenly over your oven's useful life. But we also have the double declining balance and some of the year's digits methods. These are what we call accelerated variable cost depreciation methods, where the expense is higher in early years. And then we have the units of production method. This is also a variable cost depreciation method, but it's not accelerated. Instead, the depreciation expense mirrors the actual physical use of your asset. But in this video, let's assume that you're using the straight line method. Here's your completed depreciation schedule. This table summarizes the depreciation expenses, accumulated depreciation, and book values of your oven over its useful life. You can learn how to make one of these in my straight line depreciation video, but I'd recommend sticking around because I'm going to show you how to record all of these transactions in your business's books. How to record depreciation using journal entries. A journal entry is a record of a financial transaction, and to help us figure these out, we'll use Dealer. If you've been watching accounting stuff for a while now, then you might be familiar with this, but if you haven't, then maybe click subscribe, why not? Dealer is an accounting acronym that stands for dividends, expenses, assets, liabilities, equity, and revenue. DEA represent normal debit accounts, which means they increase when debited and decrease when credited. LER are normal credit accounts. These do the opposite. They increase when credited and decrease when debited. So let's do this. How to capitalize an asset purchase. At the start of year one, you bought your oven for $8,000, but what's the journal entry? This is journal number one, and as usual, it has 4 columns. Date, the account affected, debits, and credits. You're going to post this in year one to record your asset purchase, but which accounts will be affected? We know that cash needs to go down by $8,000. Cash is an asset to the A in dealer, so it's a normal debit account, which means that debits increase it and credits decrease it. So we'll credit your cash account by $8,000 to decrease its value in your balance sheet. We're double entry accounting, so there are at least 2 sides to this transaction. What's the other one? It has to be a debit because total debits need to match total credit. But we can't debit expenses in the income statement. Not yet anyway, because we're using the accrual method. So we need to capitalize the cost of your oven and hold it as a tangible fixed asset. Assets are normal debit accounts, so we'll debit your baking equipment account by $8,000 to increase assets in your balance sheet. We can see the impact of this journal on your bakery's books using T accounts. So far, you have one for cash and one for baking equipment. A T account is a visual representation of an account where debits go on the left and credits go on the right. In Journal 1, you credit the right-hand side of your cash account by $8,000 to decrease it, and debit the left-hand side of your baking equipment account by $8,000 to increase it. This is a balance sheet to balance sheet transaction. How to record a depreciation expense using journal entries. During year one, you write off $800 as a depreciation expense to your income statement. What does this journal look like? We know it's going to hit the depreciation expense account in your income statement. Expenses are the first E in dealer, normal debit accounts, which means the debits increase them. So you debit your depreciation expense account by $800 to increase it in your income statement. But where does the other side go? We need to decrease assets in your balance sheet, so you might think it logical to credit baking equipment. And you're not wrong, that would make sense, but we don't do that. Instead, we're going to credit an account called accumulated depreciation by $800. Accumulated depreciation is the cumulative total of all depreciation expenses incurred. This might take a little bit more effort, but doing it this way helps to keep things organized, and that's a good thing. It'll make more sense with T accounts. You'll need 2 new ones, accumulated depreciation and depreciation expense. In your second journal, you debit depreciation expenses by $800 to increase them in your income statement, and you credit accumulated depreciation by $800 to reduce the value of your oven in the balance sheet. Your baking equipment and accumulated depreciation accounts both sit in the asset section of your balance sheet. Baking equipment is a normal asset account, whereas accumulated depreciation is what we call a contra asset account. What's a contra asset? It's a normal credit account which contrasts or runs against the flow of normal assets.
A contra asset.
If you want to know the book value of your oven, then all you have to do is net these 2 accounts together. $8,000 minus $800, which leaves you with $7,200 in your balance sheet. So in year one, your cash went down by $8,000 and baking equipment went up by $8,000. But later on, this is offset by an $800 increase in accumulated depreciation because you've written off $800 as a depreciation expense to your income statement. We can see all of this here in your depreciation schedule. At the end of year one, you have $800 in depreciation expenses, $800 in accumulated depreciation, and a closing book value of $7,200. Are you still with me? It gets better, I promise. We're using the straight line method, which means your depreciation expense is exactly the same for the next 9 years. So the next 9 journal entries are identical to the one we just posted. Each year you debit the depreciation expense account in your income statement by $800 and credit accumulated depreciation in your balance sheet by $800. And here's the impact on your books. At the start of year one, you buy an oven, so your cash went down by $8,000 and your baking equipment went up by $8,000. This is a balance sheet to balance sheet transaction. But during each of the next 10 years, you post adjusting entries to record a depreciation expense in your income statement of $800 and $800 in accumulated depreciation, a contra asset account which offsets the asset cost in your baking equipment account. After 10 long years, the entire cost of your oven has been written off to your income statement. So if we net together your baking equipment and accumulated depreciation accounts, we can see that the closing book value of your oven has decreased to 0, which agrees with your completed depreciation schedule. So what's next?
Nothing.
Well, not exactly. If you continue to use your oven, then it'll be fully depreciated, but you'll still be carrying it in your books. $8,000 in your baking equipment account and $8,000 in accumulated depreciation, but combined a net book value of 0. When you stop using it, you'll need to post one more journal entry. Assuming no gain or loss on disposal, you'll debit accumulated depreciation by $8,000 and credit baking equipment by $8,000. This journal clears out all of the older entries in your baking equipment and accumulated depreciation accounts, leaving you with a balance of 0 in each account. Now that we've dealt with some depreciation basics, let's get into the 4 different depreciation methods. Starting with the straight line method. And FYI, I do have a depreciation cheat sheet, which I'll leave a link to down in the description. Depreciation is the process of reducing the book value of a tangible fixed asset due to use, wear and tear, the passing of time, or obsolescence. Straight line depreciation is a fixed cost depreciation method where the expense is spread out evenly over an asset's useful life. What does that all mean? Let me show you. Imagine that you're a farmer. I know, a bit random, but stay with me. You own a whole bunch of tangible fixed assets. These are the physical things that help you out on the farm. They are tangible, meaning that you can touch them, and they're fixed, so you intend to use them for more than 1 year. As time passes, these tangible fixed assets wear down and aren't worth as much as they were when you bought them. Take your combine harvester. Let's assume that this one cost you $450,000. You expect to get 12 years of use out of it, and after that you'll probably sell it for scrap and get back around $90,000. Let's depreciate it using the straight line method. Step 1. Write down what you know. You know that this asset is a combine harvester and that you're going to depreciate it using the straight line method. The asset cost is what you initially paid for it, $450,000, a lot of money. You estimate that its residual value or salvage value is $90,000 and that it has a useful life of about 12 years. Step 2. Build a depreciation schedule. A depreciation schedule is a table, and for straight line depreciation, it has 5 columns: year, opening book value, depreciation expense, accumulated depreciation, and closing book value. But what do all of these terms mean? Year is the accounting period. Opening book value is the carrying amount of your combine harvester at the start of the year. This sits in your balance sheet. Depreciation expense is the value that you write off as an expense to your income statement during the year. Accumulated depreciation is the cumulative total of all depreciation expenses incurred, and closing book value is the carrying amount of your combine harvester at the end of the year. Step 3. Calculate the depreciation expense, accumulated depreciation, and book values for each period. This is where things get real. Yes, we need to fill in all of the blanks. Let's begin with your opening book value. This one's easy. It's your asset cost, $450,000. Now let's work out your depreciation expense. I mentioned at the start that straight line depreciation is a fixed cost depreciation method where the expense is spread out evenly over the asset's useful life. So grab your calculator, we're about to do some maths. The depreciation expense can be calculated by taking your straight line depreciation rate and multiplying it by your depreciable cost. Your straight line depreciation rate is 1 divided by the useful life of your combine harvester, So that's 1 over 12 years, which rounds to 8.33%. Depreciable cost is the difference between your asset cost and residual value. $450,000 minus $90,000 is $360,000. This is the portion of the book value that we're depreciating. 8.33% multiplied by 360,000 is $30,000, your combine harvester's depreciation expense in year 1. Make sense? If you need any help remembering the formula, you can find it on my depreciation cheat sheet, which you can buy on my website. Link in the description. Next, we need to work out your accumulated depreciation, which is the sum of all depreciation incurred to date. In year 1, this is $30,000, exactly the same as your depreciation expense. Your closing book value is the carrying amount of your combine harvester in your balance sheet at the end of the year. We can work it out by taking your opening book value and subtracting your depreciation expense. $450,000 minus $30,000 is $420,000. Now with year 1 out of the way, we just need to repeat the process over and over again for the next 11 years. Your closing book value in year 1 becomes your opening book value in year 2. Your depreciation expense is fixed because we're using the straight line method, so it's $30,000. Accumulated depreciation is $60,000, and your closing book value is $420,000 minus $30,000, which is $390,000. The process doesn't change. So here's the completed depreciation schedule. You started off with a combine harvester costing $450,000. You then wrote off $30,000 as a depreciation expense to your income statement each year for the rest of your asset's useful life. You might notice that after 12 years, the closing book value of your combine harvester is $90,000, and this matches the residual value that we chose earlier, which is good because it means we haven't made any mistakes, which is always a good sign. Let's take another look at that graph. Here we're tracking your combine harvester's book value over time. Your asset cost at the beginning is $450,000 and its residual value at the end is $90,000. Its depreciable cost is the difference between the two, $360,000, and it has a useful life of 12 years. Straight line depreciation is a fixed cost method, which means the expense is spread out evenly over your asset's useful life. But there are other variable depreciation methods as well, where the expense is higher in early years, and these can be a bit more tricky. Not too tricky though, I promise. An example of a variable cost depreciation method is the double declining balance method. How does it work? Let's find out. Double declining balance depreciation is an accelerated variable cost depreciation method where the expense is higher in early years. Let's expand on this with an example. Pretend for a moment that you're an architect. You design beautiful new houses for a living. One day on the job, your old laptop finally kicks the bucket, so you have to buy a new one. It costs you $2,500. This new laptop is what we accountants call a tangible fixed asset. It's tangible because you can touch it, and it's fixed because you plan to use it for a long time. In this case, probably 5 years. Let's depreciate it using the double declining balance method. Step 1. Write down what you know. Your new asset is a laptop, and we're depreciating it using the double declining balance method. Your asset cost is what you initially paid for it, $2,500. With this method, we can ignore residual value. Useful life is 5 years, and we can leave depreciation rate blank for now. We'll return to that in step 3. And we can ignore depreciable cost as well. Step 2. Build a depreciation schedule. When using the double declining balance method, the depreciation schedule is laid out in exactly the same way as it was last week when we covered the straight line depreciation method. It's a table with 5 columns. We have year, opening book value, depreciation expense, accumulated depreciation, and closing book value. Step 3. Calculate the depreciation expense, accumulated depreciation, and book values for each period. This is where we get to fill in all of the blanks. And we'll start with year 1. This is the first accounting period. Your opening book value is the carrying amount of your laptop at the start of the year. This is the same as your asset cost, $2,500. Now let's work out your depreciation expense. This is the portion of your laptop that you write off as an expense to your income statement during the year. Remember that double declining balance depreciation is an accelerated variable cost depreciation method, where the expense is higher in early years. This graph looks quite different to the straight line depreciation one, but the two are linked, because in the double declining balance method, your depreciation expense is equal to 2 multiplied by your straight line depreciation rate, multiplied by your opening book value. Your straight line depreciation rate is 1 divided by the useful life of your laptop. So in this case, that's 1 over 5 years, which is 20%. Your opening book value is the carrying amount of your laptop at the start of each year. In year 1, it's $2,500, the same as your asset cost. But be careful because this changes each period. 2 multiplied by 20% is 40%, your double declining balance depreciation rate. 40% of $2,500 gives you $1,000, which is your laptop's depreciation expense. Accumulated depreciation is the sum of all depreciation expenses incurred to date. In year 1, it matches your depreciation expense, so it's $1,000. Closing book value is the carrying amount of your laptop at the end of the year. This is the net asset amount that you hold in your balance sheet. It's your opening book value of $2,500 minus your depreciation expense of $1,000, so $1,500. Your closing book value in year 1 becomes your opening book value in year 2. Your depreciation expense is your double declining balance depreciation rate multiplied by your opening book value at the start of the year. So that's 40% multiplied by $1,500, which is $600. Accumulated depreciation is $1,600, and your closing book value is $1,500 minus $600, which is $900. Now, this is what we're left with if we repeat the technique for the rest of your laptop's useful life. You start off with a laptop costing $2,500 and you write off a depreciation expense to your income statement each year. After 5 years, you're left with a closing book value of $194. Note that the depreciation expense changes each time. Let's see this plotted on the graph. This is your laptop's book value over time. Your asset cost at the beginning is $2,500, and it has a useful life of 5 years. The depreciation expense is variable because it changes each year, and it's accelerated because it's higher in early years. But the double declining balance method isn't the only accelerated depreciation method. In the next video, I'll cover another one called sum of the year's digits. You heard the man, sum of the year's digits. Let me break it down for you. Sum of the year's digits depreciation is an accelerated variable cost depreciation method, where the expense is higher in early years. Time for an example. You know that big empty field you own? The one behind your house that catches all the sun? Anyways, one day you decide to turn it into a solar farm. A solar panel is a tangible fixed asset. It's tangible because you can touch it, and it's fixed because you plan to use it for a long time. Each panel cost you $25,000 and is expected to last for 5 years. By the way, did I mention that you're also really, really rich? After that, their value will drop right down to $5,000. Let's depreciate one of these panels using the sum of the year's digits method. Step 1. Write down what you know. Your asset is a solar panel, and we'll depreciate it using the sum of the year's digits method. Asset cost is what you initially paid for it, $25,000. Its residual value at the end of its useful life is $5,000, and its useful life is 5 years. We'll leave depreciation rate and depreciable cost blank for now because we'll work these out in step 3. But first, step 2, build a depreciation schedule. A depreciation schedule is a table, and for the sum of the year's digits method, it has 6 columns, so that's one more than we used for the straight line and double declining balance methods. We have year, opening book value, depreciation rate, depreciation expense, accumulated depreciation, and closing book value. Can you guess which one's new? It's depreciation rate. We're going to give depreciation rate its own column because this is going to change each year. Step 3. Calculate the depreciation rate, depreciation expense, accumulated depreciation, and book values for each period. Time to fill this sucker out. We'll begin with the first accounting period, so that's year 1. Your opening book value is the carrying amount of your solar panel at the start of the year. This is your first accounting period, so that's going to match your asset cost of $25,000. Now let's work out your sum of the year's digits depreciation rate for year 1. By the way, we often shorten sum of the year's digits to just SYD. It's just quicker to say, I guess. Your SYD depreciation rate is equal to the remaining useful life of your asset divided by the sum of the year's digits. Your remaining useful life is exactly what it sounds like. How many useful years you have left on your solar panel. We said at the start that it has a useful life of 5 years, so in year 1 its remaining useful life is also 5 years. But be careful because this top line changes each period. Now the bottom line is called the sum of the year's digits and it doesn't change. We only have to work it out once. There are 2 ways to do that and I'll show you both. The long way is more intuitive. We're after the sum of the year's digits, so all we need to do is add up each year of your solar panel's 5-year useful life, so 5 plus 4 plus 3 plus 2 plus 1, which is 15 years. Seriously, that's all there is to it. Now for the short way. Mathematicians call a series like this the sum of an arithmetic series, and they've derived a short formula that'll give us the answer every time. Sum of the year's digits is equal to useful life multiplied by useful life plus 1 divided by 2. So let's test it out. 5 years multiplied by 6 years divided by 2 gives us 15 years. Choose your method, it doesn't matter which, and let's move on. Your depreciation rate for year 1 is 5 years, which changes each year, divided by 15 years, which remains the same. This gives us 1/3 or 33.33%. Now let's calculate your depreciation expense. This is your SYD depreciation rate multiplied by your depreciable cost. It represents the amount of your solar panel that you'll write off as an expense to your income statement during the year. Keep in mind that the sum of the year's digits method is an accelerated variable cost depreciation method, where the depreciation expense is higher in early years. We'll come back to this graph in a moment. We've already worked out your depreciation rate for year 1. It's 33.33%. Your depreciable cost is the difference between your asset cost and residual value. $25,000 minus $5,000, which is $20,000. This is the chunk of your solar panel's book value that will depreciate over its useful life. 1/3 of $20,000 is $6,667. Your solar panel's depreciation expense in year 1. Accumulated depreciation is the sum of all depreciation expenses incurred to date. In year 1, it's the same as your depreciation expense. Closing book value is the carrying amount of your solar panel at the end of the year. This is the net asset amount that you're holding in your balance sheet. We can work it out by taking your opening book value of $25,000 minus your depreciation expense of $6,667, which is $18,333. Now we'll repeat the process for the following period. Your closing book value in year 1 becomes your opening book value in year 2. Your depreciation rate is the remaining useful life of your asset divided by the sum of the year's digits. This is year 2, so your remaining useful life has reduced to 4 years. Sum of the year's digits doesn't change, it's still 15 years. So 4 years divided by 15 years gives you an SYD depreciation rate of 26.67%. Your depreciation expense is your SYD depreciation rate multiplied by your depreciable cost. So that's 26.67% multiplied by $20,000. Which is $5,333. Accumulated depreciation is $12,000 and your closing book value is $18,333 minus $5,333, which is $13,000. Here's the completed depreciation schedule for the whole of your solar panel's useful life. Your asset cost at the start is $25,000, and we've written off a depreciation expense to your income statement each year. After 5 years, the closing book value of your solar panel has decreased to $5,000, which is exactly the same as the residual value that we picked at the start. This is just a handy little check to make sure that we've done things right. Let's have another look at all of this on a graph. This is your solar panel's book value over time. Your asset cost at the beginning is $25,000, and its residual value at the end is $5,000. Your depreciable cost is the difference between the two. The solar panel has a useful life of 5 years, and its remaining useful life decreases over time. The depreciation expense is variable because it changes each year, and it's accelerated because it's higher in early years. But not all variable depreciation methods are accelerated, as you'll see in the next video where I'll cover the units of production method. It's true, the units of production method is variable, but it isn't necessarily accelerated. Allow me to explain. The units of production method of depreciation is a variable cost depreciation method, where expenses mirror the actual physical use of the asset. Picture this. One day you decide to make the move to the Pacific coast of Canada. There are more trees here than you could ever imagine, and being an enterprising young person, you decide to open up a sawmill. So you secure a location and buy your first sawmill machine. It costs you $10,000. Your sawmill machine is a tangible fixed asset. It's tangible because you can touch it, and it's fixed because you plan to use it for a long time. This one can produce 150,000 units of timber, and after that it'll be worth $1,000 in scrap. Let's depreciate it using the units of production method. Step 1. Write down what you know. Your asset is a sawmill machine, and we're going to use the units of production method of depreciation. The asset cost is $10,000, its residual value is $1,000, and we expect it to be useful for 150,000 units. We'll calculate the depreciation per unit and depreciable cost in step 3. Step 2. Build a depreciation schedule. A depreciation schedule is a table, and in the units of production method, it has 6 columns. We have year, opening book value, number of units produced, depreciation expense, accumulated depreciation, and closing book value. The number of units produced is an extra column that we include for the units of production method. We need to track this period by period to help us work out your depreciation expense. Step 3. Calculate the depreciation expense, accumulated depreciation, and book values for each period. Now it's time for us to fill out the schedule, and we'll start with year 1, which is the first accounting period. Your opening book value is the carrying amount of your sawmill machine at the start of the year, and in year 1, this is $10,000, the same as your asset cost. Your business carefully records the number of units produced, and it turns out that in year 1, that was 18,000 units of timber. Now, your depreciation expense is your depreciation per unit multiplied by your number of units produced. We can work out your depreciation per unit by taking your depreciable cost and dividing it by the total useful units. What is depreciable cost? It's your asset cost minus residual value. It represents the portion of your sawmill machine that will depreciate over its useful lifetime. Your asset cost is $10,000 and its residual value is $1,000. So your depreciable cost is the difference of $9,000. We said that your sawmill machine can produce 150,000 useful units. So your depreciation per unit is $9,000 divided by 150,000 units, which comes to $0.06 or 6 cents per unit. By the way, depreciation per unit is very similar to the depreciation rate that we discussed in my other videos, but depreciation per unit is expressed as a cost per unit, whereas depreciation rate is a fraction of an asset's useful life. Anyway, we can now calculate your depreciation expense. This is your depreciation per unit multiplied by the number of units produced. You produced 18,000 units in year 1, so if we multiply that by 6 cents per unit, Then you've got a depreciation expense of $1,080. This is the amount of your sawmill machine that you'll write off to your income statement. Here's another thing to bear in mind. Your depreciation per unit is constant, but your number of units produced will change each year. So your depreciation expense under the units of production method is going to be a variable cost to your income statement. It's going to mirror your actual physical use of the asset. Accumulated depreciation is the cumulative total of all depreciation expenses incurred. In your first accounting period, it will match your depreciation expense. Your closing book value is the carrying amount of your sawmill machine in your balance sheet at the end of the year. It's your opening book value of $10,000 minus your depreciation expense of $1,080, which is $8,920. This then becomes your opening book value for year 2. Let's say it's a slow year and you only managed to produce 13,000 units of timber this time round. Again, your depreciation expense is the depreciation per unit multiplied by your number of units produced. Depreciation per unit is a constant 6 cents per unit, and you produced 13,000 units. So your depreciation expense is 6 cents per unit multiplied by 13,000, which is $780. Your accumulated depreciation is the cumulative total of $1,860, and your closing book value is your opening book value of $8,920 minus your depreciation expense of $780, which is $8,140. If we repeat this process for the next few years, then this is what we're left with. Notice that your depreciation expense changes each year in proportion to the number of units you produced. We can see this better on the graph. This shows your sawmill machine's book value over time. Your asset cost is $10,000, its residual value is $1,000, and your depreciable cost is the difference of $9,000. Under the units of production method, your depreciation expense is variable because it changes each year, mirroring your actual physical use of the asset. I know, we covered a lot here. If you forgot to make notes, then you might find my depreciation cheat sheet helpful. I've left a link to it down in the description as well. Remember to subscribe if you haven't already, and if you're hungry to learn more about accounting, then why not watch this video next? I'll see you there.